Hey, all right. Morning, everyone. Welcome back to our morning kappa at 8. I'm Joseph here. So looking at the Hang Seng, right, last Friday, it did stage a rebound. But so far, Hang Seng Index remains on a bearish setup right now, with the support, with the resistance at 2750 point level. So looking at the last week performance, I can see that most of the stocks have strong corrections, but the 857 and 883, these two oil-related counters did make a rebound last week, right? And look, today, this morning, we see opportunities in these two Hong Kong listed counters. Firstly, Xian Power, that actually in the nuclear plant business, stock code 1816. They have a break past the Hong Kong dollar 25 cents. So after a breakout, it's eyeing the R1 at 340 and followed by 3 ringgit at 3 Hong Kong dollar 55 cents. Downside support is 3 Hong Kong dollar 10 cents. Then on we have the China Coal Energy 1898, which break past 1350. R1 is 1450 and followed by 1550. Downside is 1250. One of the reasons that we are looking at the coal, right? I think the commodity stocks have garnered a lot of attention recently, right? Then on, I think two pieces of news that have um, affect the market sentiment. Firstly, is the Qatar have shut down their world largest aluminium smelter. And I just want to mention to you that the smelter should run 24/7. So once they shut down, it takes them another 1 year to fully be online again. So I think since they have shut down this smelter, the aluminium market will have disruptions for the next 1 year at least, right? And then on, because of the closure of the Hormuz Straits, right? China have urged the Chinese refiners to halt their petrochemical exports, right? And refined product exports. That actually is a good news to most of the refined products traders in the world, as for the past I think some years, right? The refined products market has been facing a very strong competitions from these Chinese refined product producer, where the prices have actually come down due to the over supply market conditions. Since now China have stopped these refined products exports, that give a breather for the refined product traders worldwide, especially for the Malaysians refined products traders. As for the XPX, last week the index have down, right? But we do see the Palantir have bucked the trend and went up by 17%, followed by the Bitcoin related Coinbase also went up by 12%, right? And as of the Malaysia market, right, FKLI is consolidating with a stop loss or the major resistance at 1750. Then on FCPO have break past the 4250 resistance last week, and right now we do see the bulls in control right now. Next resistance is 4005 followed by 4550, right? And two counters that I think that still be a trading opportunity. Firstly, the Petronas Chemical, which will break past the 4 ringgit last week, due to what I mentioned to you, the China have halt the refined product export. Right, sentiment have been positive on our refined products counter. Right, the next level before ringgit is 75 and followed by 540. On the downside, I think the support will be at 3 ringgit and 30 cents. I think the uptrend remains intact for the Petronas Chemical, and the momentum remain strong right now. Then on, as of this morning, the oil price continue hovering at almost year-to-date high, right? Sentiment remain positive on the petrol market, especially the upstream producer, people like Hibiscus. where they have a lot of spare capacity right now. It just break past the 2 ringgit, and the next level will be 230, 220, and followed by 2 ringgit and 40 cents. Downward support should be their recent low somewhere at 1 ringgit and 85 cents, right? And apart from these two counter, right? Iman do see the opportunity on the Bumi Armada, which I aim to break past 36 cents ringgit. If the breakout happen, Bumi Armada will be testing 39 cents and followed by 42 cents. Downside support is 33 cents. Secondly, we have PJ Bumi break past 2 ringgit and 25 cents. Heading towards 2 ringgit 40 and followed by 2 ringgit 55. Downside support is 2 ringgit and 10 cents. So we have Bumi Armada and breakout stock PJ Bumi. So I'll stop here and pass on to the next presenter. Thank you.
Thank you, Joseph. Thank you for your sharing. Let me share my screen first. So, morning everyone. I'm Xian Yong talking about global economics outlook. So, in this week, we saw that our global risk sentiment index has continued to weaken. So, if we can look at the chart on the blue line here, we can saw the risk sentiment index has falling, showing a risk off, slightly risk off, but this is due to a rising VIX index on the fear index, as growing concern about the potential escalations of the geopolitical tension in Middle East. So for now, the current market pricing appear to largely driven by geopolitical risk rather than the deteriorations of the underlying economic fundamentals. So we remain hopeful as swift recovery can be achieved within 1 month, as indicated by US President Donald Trump, which could last almost like 1 month. So our key conviction here is to stay cautious and defensive, which with a preference on crude oil and safe haven assets such as gold and US Treasury. So should these tensions intensify further, we expect a 5 to 10% decline in the global equities due to heightened volatility. So if you say global risk appetite will turn more risk on, not one risk neutral or risk off after risk on mode, we can see it's early of the year. So one key concern is about inflations, particularly across ASEAN, because Brent oil rally, if this persists, this could translate to a widespread of inflation across ASEAN regions. Particularly if you look at Indonesia in the February charts, February data, inflation has picked up by 4.8%. While this is due to the seasonal demand, we do not rule out it could happen in March onward due to energy related prices. So our correlation analysis, if you look at our right hand side chart, global industrial productions price index as well as Brent and LMBX index have our analysis shows they have a 1 month lead lag relationships. So a declaration of this conflict likely to prompt rapid normalizations in the market conditions, allow the global equity to re-anchor on solid fundamental. If otherwise, Brent oil and pick up, and this could transfer to inflation and rising costs across the ASEAN regions. So on the Fed side, you can look at we still look at the baseline view for another 2 cuts in the Fed rates. So however, rising inflation risk has already pricing in for the Fed swap pricing. You can see at December's. So market data are now pointing toward the fully pricing at 1 cut at September, which is 1.03 at here, and also compared to early before the conflict, where it's point to a cut in July. So we see that we also do not rule out there's a possibility for even 1 or no cuts in 2026 if these prolonged geopolitical tensions could trigger a sustained inflation risk through the oil supply shocks. So let us also proceed to what we've seen from Malaysia. So we also did some analysis on Malaysia due to the Iran crisis. So our main conclusion is that this impact is likely expected to be limited because as well, trade and tourism income has relatively low exposure to the Middle East economies. So the trade to Iran account only for 0.1% of the total trades, and the tourist arrival only account for 0.2, very small. Similarly, on broader, we look at the Middle East regions, the total trade account for 4.2%, and also tourism arrival just 1.1. So we are still remain optimistic about the export in 2026, caution on the regarding the development in the global engineer front. However, prolonged escalation of this conflict might trigger overall slower growth exports or even slower export coming from major economies, including US, China, EU. So this could partially spill over toward investment income and external income. So for now, we're keeping our target to limited, but hopefully there won't be any new escalations. So another than that, the Bank Negara Malaysia has also maintained the OPR unchanged at 2.75 in the last meeting. So in line with our expectations and also the market forecast. So this is due to very robust growth of more than 5% growth in last year, as well as the inflation remain manageable. But BMN has also acknowledged that there will be likely uncertainty coming from the ongoing Middle East crisis if global commodity prices face greater volatility. So we remain cautious on this and see that domestic inflation expected remain contained, still around the 2% level. Supported by very strong domestic demand and sound financial system. So that's all from me. I will pass on to Adam. Thanks.
Okay, good morning everyone. So today we have a results review on Gamuda's first half FY26 results, which saw its core earnings of 442 million ringgit. That was 8% year-on-year higher, meeting 42% of our estimates, which we deem to be in line as we expect a stronger second half of FY 2026. So, in terms of its construction PAT, which was I think 6 or 7% year-on-year higher. That was mainly due to a stronger domestic earnings mix coming from key domestic ongoing projects like the data center projects in Almina and also the Rasa Stage 1 project, which are expected to be completed sometime this year and also next year. Looking at the property arm, well, PAT was a bit flattish at 3% year-on-year growth. As you know, there was Malaysia's township was a bit slow, but most of the earnings were skewed towards Vietnam property projects. But within the next 12 months, Gamuda plans to launch 10 billion worth of GDV of projects. Around 40% out of that 10 billion is expected to come from 4 new land deals in Vietnam, and the rest is expected to come from the Singapore Chincharu project and some Malaysian townships. The 50 billion ringgit target for its balance order book by end calendar year 2026 remains well intact in our view. Given that there's a lot more opportunities from Australia on top, of expected DC projects and maybe some infra projects in Malaysia, namely the Sabah Water Supply Scheme. All in, we made no changes to our earnings estimates as we deem results to be in line, maintained by with an unchanged target price of 6.26 ringgit. The stock is trading at a forward PE of around 18 times, which is, not as demanding as other peers, namely Suncon, which is trading at about 20 times as we speak. So that's about it from me for Gamuda today. I'll pass on the floor to the next speaker. Thank you.
Okay, we have a company update on Telekom Malaysia, TM. This follows a recent call that we have, between institutional investors and management team. Two key points to highlight. Number one, of course, the dispute between TM as well as DNB in terms of the 5G access. Now, TM said that they fully complied with the legal provisions and terms governing the termination of wholesale access agreement with DNB. Now, if you look at the terms, allows access seekers to terminate the agreement within 30 days of the release of the RAW, which is the reference access offer by another access provider. Now, which is U-Mobile, that's the second access provider for 5G. They published their RAW 25th of January. So TM is just basically exercising the rights within the current access agreement to basically cancel that or provide notice for the cancellation. Now, in the worst case scenario, they did say that they may continue to the existing arrangement with DNB for another year, which means that they would still have to fork out circa 300 million in terms of wholesale costs to DNB up to January 2028. Now, we don't actually know what will transpire, obviously. That whole cancellation process, I think it will be mediated by MCMC. It's something that the regulator would need to provide their consent on. So 127 million in terms of prepaid unutilized capacity, that's something that TM will have to forego if they do proceed in terms of cancelling the current wholesale agreement with DNB. Now, in addition to accessing a newer 5G standalone network on U-Mobile, the current, they've just signed an MOCN agreement, to reach out of DNB. It will basically, offer fairly good cost savings for TM. For one, I think the access cost is lower compared to DNB. So it all boils down to improve economics as well. As you know, TM's mobile business, is a converged business, supplements the overall retail franchise for TM. It's not meant to be something of a pure play sort of growth versus that of its larger mobile peers, obviously. So I think it's more cost effective for them to actually ride or capitalize on U-Mobile's network. Second point I want to highlight is really on dividends. I think expectations on dividends are rising for TM purely because the balance sheet is incredibly strong at this point. Net debt to EBITDA is already at record low of 0.4x. They've said that they will basically fund capex going forward by gearing up the balance sheet, leaving internally generated cash to be distributed to shareholders. Now, if you look at the FY25 dividends, which was announced a couple of weeks ago, paid about 31 cents. The dividend payout ratio at 69% is already at a record high. Now, that compares with the DPR of 40 to 60% of reported headline PATAMI. So they're paying above the previous payout ratio. I think they're in the midst of reviewing their payout. It's something that you have to basically watch the developments very closely. They may announce a new payout ratio sometime in the second quarter of this year. Core business in terms of TM, I think it will continue to do fairly well. The retail business, which is the unified business, that has grown about 3%. That run rate should continue this year, basically supported by converged offerings. Circa 50% of the base are on converged plans. The wholesale business, which is the other third of the business for TM or TM Global, that should also sustain a high single-digit growth. Last year was about 8%. I think this year, they probably do about 8 to 10%, or even may exceed that 10%, low teen sort of growth. Really, it's coming from the additional subsea cable capacity, managed services for data centers and all. I think the TM1, which has disappointed in the past before, that's the enterprise business of TM. I think this year it should be a better year for them. For one, there's been a change in leadership. I think the change in leadership, a lot of the targets are reviewed. A lot of the issues with TM1 in the past, where the government sector or the public sector has basically renewed their contracts at a lower price, I think that's probably behind them now. And the two new DCs, not really new DCs, but they've expanded their DCs down in Johor as well as Cyberjaya. The expanded capacity are now on stream. And we gathered that Iskandar Putri, the DC, they've already secured about 30 to 40% in terms of pre-sold inventories. And for KVDC, which really started the early part of this year, it's slightly less than half in terms of pre-sold capacity. So DCs, I think it's something that will be, a key strong growth driver for them. And don't forget, there's also that 64 megawatts JV with Singtel, TM Nextra, which will be coming up sometime second half of this year as well. So what we've done in terms of our forecast is that we've lifted, 27 and 28 numbers by between 1 to 9%. We factored in lower financing cost, manpower cost savings, and stronger enterprise growth, particularly on the DC side of things. Very minor adjustments in terms of FY26 numbers for now. We've also upped our dividend assumptions going forward. Target price has been increased to 930 from 890, giving more than 24% upside from current levels. And if you look at the yields, it's about 4%, not too shabby. So TM remains our preferred pick for exposure to the sector. Okay, that's it for me for now. Thanks for having us today. I'll see you again tomorrow.